A few years ago, a local orthodontist that was actually an active real estate investor knew that I was learning about real estate. So he said, Jeff, I think a great podcast for you to listen to is one by a guy by the name of Keith Weinhold, Get Rich Education. Started listening to it, man, it really expanded not only about the real estate, but all the other different things about taxes, passive income that you can learn. And it really instrumental about helping me learn about real estate. Fast forward to now, this is a really cool for me to take somebody that was I look up to and as a mentor to be have here on the channel with us. So Keith, super excited about you being here with us today, and thanks for joining.
Oh, it's an honor to be with you, Jeff. Thanks so much for the invitation.
So for those out there that don't really know too much about you and your background, how did you get started in real estate?
In a very modest way, because I came from modest means. I didn't have a lot of money to start out. So, Jeff, I started out by putting a 3.5% down payment on the first property of any type that I would ever own. And that was an Anchorage, Alaska fourplex building. I learned with an FHA loan, virtually anyone qualifies to put just 3.5% down on a single family home, duplex, triplex, or fourplex. Most people just use that for a single family home. There's nothing wrong with that. But that loan program states that I only need a minimum credit score of 580, and I need to live in one of the units for at least 12 months. And that's what I did with a $295,000 fourplex. That's how I started, living in one unit and renting out the other three. That's how virtually anyone can start with a bang in real estate investing, Jeff.
Awesome. So how did you go from there to what you're doing now? I know it's the podcast and YouTube channel, and I mean, you're really big social media influencer. Kind of walk us a little bit through how you went from an active investor to now, this big influencer.
Okay, yeah, that's really interesting to talk about, because when I had owned and bought that fourplex building, I was an everyday job worker at a state department of transportation. And with buying that fourplex building and taking equity out of that without adding much of my own money and using that as down payment seed money for other properties, pretty soon I was getting some substantial residual income from doing this. So my coworkers at the DOT, after a few years, they could soon see that this was affecting my lifestyle. And, oh, you and your wife are going to Hawaii again, and now you're going on this Caribbean cruise. And when I worked with coworkers, we all make about the same amount of money, and we all know what each other makes. So they wondered how I did this. So people would show up in my 8-foot by 10-foot blue cubicle at the DOT and start asking me about just how I'm doing, what I'm doing. So what that really did, Jeff, is that gave me practice explaining some of these concepts, like don't live below your means, grow your means, or don't focus on getting your money to work for you. You can get other people's money to work for you ethically. It just sort of gave me practice talking to my coworkers at work. And with more practice, I just got used to talking about this. And I told myself, well, I can multiply these conversations rather than having to repeat it over and over again with coworkers by launching a podcast in 2014. And little did I know that would turn into the most successful thing that I've ever done in my life, the Get Rich Education podcast. But really, Jeff, that turning point was practicing with coworkers. Even though I didn't know I was practicing, I was just simply explaining, doing what I was doing. And you know what, Jeff? Most coworkers, they didn't act on the information. They just thought, oh, that's interesting to hear. A few of them acted on it, but most didn't. They just thought, oh, well, that's your life. And that was interesting to learn about. That's something else. Let me go back to this spreadsheet.
That's awesome. That's kind of how my journey is kind of done too. I was just out there just telling other people about what I'm doing and investing in real estate, kind of like you. And then next thing you know, blog, YouTube channel. So that's cool how that kind of thing starts, isn't it?
It's organic. Yeah.
Yeah, that's awesome. Now, one of the things that if anybody out there, if they're in real estate and they've heard a podcast or YouTube channel, or they've been to a real estate meeting or convention, it seems like 9 times out of 10, you're going to learn about having to get into the right mindset. And, with me, I was supposed to join a group practice here. That whole deal fell through, and I immediately went into like a scarcity fear type mode. And it took a long time to break out of that mindset. So how important is it to have the correct mindset, like an abundance mindset? What do you think about that if you're wanting to be financially successful?
Well, you mentioned that common four-letter F word, and that word is fear, F-E-A-R. And humans are biogenetically predisposed to react to fear and want to run from fear, and
Hmm.
oftentimes protect themselves from what can hurt them, living below their means, rather than growing their means. And how does that resonate in today's world financially? It might be, wanting to join a loyalty program to get the cheapest gasoline that you can, or organizing save 20 discount codes before you go and buy things online. Now, there's nothing wrong with that. One can do that. But I think one has to ask themselves a question: can you ever get wealthy that way? Can you ever really design the life that you want that way? No matter how much of that you do, it only has so much of an upside. And a lot of those activities, keeping the heat low in your home or something, a lot of those activities, what they really do is they diminish your quality of life. Instead of living below your means, doing those sorts of things, you can grow your means by learning about something that's really going to have an impact on your life. One great example, I really already gave it, is with that fourplex building, how I started out that way and grew from there. That's a good example of growing your means. And when you grow your means, there's an unlimited potential as to how much you can grow your means. But when you try to live below your means, you can only cut your quality of life so far anyway. So that's why I often talk about, rather than living below your means, grow your means. And you can do a little bit of both at the same time, but growing your means, that's the one that's really going to have an impact on you and is really going to change your life and elevate the quality of life of your family and other people around you.
And speaking of that, what are your thoughts about, how sometimes when either people are talking or they're being taught, these financial people are being taught, hey, don't worry about whenever you get to your retirement age, you're going to be in a lower tax bracket, and
Ah,
and sometimes people are thinking, hey, I'm going to work for 30 or 40 years, I'm going to retire, but I'm going to have to worry that I may run out of money. So what do they start doing? They start just scrimping and saving, and like you said, not going to Starbucks or whatever. And it's like, what kind of retirement is that, right?
right. Well, you talk about the retirement thing, and yeah, you touched on it, Jeff. The conventional wisdom is that when you retire, you're going to be in a lower tax bracket because you'll have less income, and that all plays into putting money into a 401k or an IRA. Well, if you're setting yourself up to have a lower income later on in your life, that's not very aspirational. You're working 30 or 40 years hard, sometimes with doing something that you're not very passionate about, just to design a lower quality of life in the future. Yeah, that really doesn't make a lot of sense. It's not a lot of lifestyle design. So when you design your lifestyle around a investment vehicle that builds passive income throughout your life, and it's something very durable and sustainable like real estate, you can grow your means all of your life. So why not a plan for prosperity? It's what you really want in your life anyway.
Excellent. Now, most of the people that come into my, blogging world or YouTube world, they're, typically physicians, dentists, attorneys, engineers, high income earners. So they're used to making a lot of money, but they're also used to paying a lot of paying a lot of taxes. And with, some of the different types of investments that we're talking about, real estate, as you know, they have some great tax advantages. So can you maybe touch on a little bit by getting that person that's always in that mode, I've got to work more to make more. Yeah, I'm going to pay more taxes, instead of working harder, maybe working smarter with the tax benefits.
401ks are known as tax deferral plans so that you don't need to pay tax in retirement, and therefore your balance can grow throughout your life. But I think of them, rather than a tax deferral plan, as a life deferral plan, because you're basically paying into this thing, reducing your income, hence reducing your quality of life. Maybe as much as 15% of your income goes in there while you're young, while you're age 25 or 35, just to hope that you get it out when you're 75. If you put $1 in when you're 25 or 35, you got to look, are you even getting a dollar back when you're 75 after you discount your rate of return for the effects of inflation and emotion and taxes and fees and volatility? So that's why I don't participate in 401ks or IRAs. I did early when I was an employee, but as
Mhm.
soon as I figured out what I just told you, that it's really a life deferral plan, I exited those plans once I saw what real estate was doing with me, with tax benefits like something called tax depreciation, where a portion of your rent income is sheltered from taxes, and a 1031 tax deferred exchange where you legally pay zero capital gains tax on the sale of your real estate if it appreciates in value. I've legally never paid one penny, Jeff, of capital gains tax in my entire almost 20-year real estate investment career now. So real estate investors get all of the tax breaks without deferring your life, building your income, and you're actually young enough to enjoy it, because we never know what's really going to happen when we're 75. So do we really want to defer our life until later or live it now? I think the answer is pretty obvious.
Well, you hit on a little bit of the tax benefits, but you have and I've heard this before multiple times. You have a great explanation of all the different ways that you can be paid with real estate. I think it's like 4 or 5 ways. So can you maybe give us kind of a highlight view of that?
Yeah, I'm glad that you touched on that, because that's not apparent to a lot of people. You know, most investors are used to getting paid one way. They try to buy lower and sell higher, which is actually harder to do than it sounds, because it's a game of emotions. When the price of something is down, you're supposed to buy the dip, but your emotion is really discouragement because that price came down. So it can
Mhm.
be difficult to buy the dip. And when something's riding high, you validate buying it because, well, there's momentum behind it and it just keeps going up. And you have this emotion of FOMO, this fear of missing out. Well, what are you doing then? What you're doing is selling low when you're discouraged and you're buying high when you're encouraged. And that's exactly the opposite of what one needs to do. Now, oftentimes we think about stocks when we think about something like that. It's something that's quite volatile. Okay, a stock might pay you a second way at the same time with a dividend. The average dividend yielding stock in the S&P 500 yields something like 2%. So some investors might get paid a second way with stocks. One big reason that I'm in real estate is really something I discovered and coined. Real estate pays 5 ways at the same time. In fact, I wouldn't even buy a property unless over the long term, I would expect to get paid all 5 ways. So this is really key in building the compelling why get into real estate in the first place. And Jeff, most experienced real estate investors, they couldn't really even explain the 5 ways they're paid. Those 5 ways are, this is over the long term, with
Mhm.
appreciation. Cash flow is the second one, which is that tenant income stream. The third one is loan amortization. You could also call that principal pay down. And if you own a primary residence, that's a benefit that you don't have, because that principal pay down each month to the bank, that comes out of your pocket. In a rental, that comes out of the tenant's pocket. The fourth way is that very generous basket of tax benefits, some of which I already described to you. And then the fifth and final way real estate investors are simultaneously paid is with an inflation profiting benefit. Yeah, you actually profit from inflation. We happen to be in a high inflation environment today. For example, if you have $1 million in debt that you owe the bank and there's 8% inflation, after 1 year, you only owe the bank back 920K in inflation adjusted dollars. And after 2 years, you only owe the bank back 840K in inflation adjusted dollars.
Hmm.
That's an 80K tailwind to you every year. Oftentimes, investors aren't even thinking about, and some people that are averse to debt. No, you have to remember, in a cash flowing rental, the tenant makes that principal and interest payment for you. So as wages and salaries and prices continue to rise, the bank doesn't ask to be repaid in inflation adjusted dollars, only nominal dollars. Nominal means in name only. So I want to explain that fifth one a bit, because oftentimes that defies common understanding. But those are the 5 ways you're paid: appreciation, cash flow, principal pay down, tax benefits, and that inflation profiting benefit that I just mentioned. Yeah, 5 ways at the same time.
So to touch on a little bit with the inflation, even so, take somebody's primary residence, even though a tenant is not paying that down, would you recommend somebody, if they have a 15 or 30-year mortgage, would you tell somebody, hey, to rush and pay that thing off as quick as possible, or let the inflation eat away the payment so you're paying less? So I know there's two schools of thoughts about that. What are your thoughts?
Yeah, that's a great question, Jeff. As long as you have security in your income stream,
Hmm.
I don't recommend paying any more than the minimum, especially now when mortgage interest rates are only about half of the rate of inflation. So, you as a borrower, you're actually benefiting from that. So, the debt that you have on your primary residence, even though you have to service and pay that yourself and your tenants don't, inflation is debasing what you owe back to the bank. So there's a pretty good chance over the long term with your mortgage interest rate that's 4% or less, you're probably going to be able to beat that over time if you take those dollars and go ahead and invest them out into the market somewhere else. So I'm not a proponent of paying down a mortgage early. In fact, oftentimes I'm a proponent of borrowing money, borrowing equity out of my home when it accumulates, because the return from home equity is always zero.
Hmm.
And inflation debases both your equity and your debt at the same rate. So inflation debasing your equity, well, that's a bad thing for you. Inflation debasing your debt, that's a good thing for you, like I've already described a bit. So therefore, I want to have more debt and less equity in my property. And that even goes for my primary residence, because I do have confidence in the diversification of income streams that I can service my home's debt over the long term.
Gotcha. Something else that we hear a lot of times is, hey, you you should go out, instead of you working so hard for your money, you need to get smart and have your money work for you. But you are, on the other hand, don't think that we should go out and get our money working for you. We should do something else instead, right?
Right. And that sounds like heresy. That is heretical to some people when they hear me say, don't focus on getting your money to work for you. It's actually not the best and highest use of your investment dollar. And that freezes some people for a moment, because that's all they've heard all their life. Let me work hard at my job being an accountant or an engineer or a doctor or a periodontist or whatever, and let me get some of my money working for me while I'm trading my time for dollars. What could be better than that? And my answer is ethically get other people's money to work for you. It's ethical. I feel like I'm doing good in the world when I provide the world with good housing. And my fourfold mission with providing good housing is providing something that's clean, safe, affordable, and functional, creating value, feeling good about what I'm doing out there in the world. But Jeff, you ask about getting other people's money to work for you. With real estate, you can actually get other people's money to work for you ethically three ways at the same time. And actually, we can harken back to that fourplex example that I started out with. It works with really any investment property. Is how I do that ethically is the first way I get other people's money to work for me is by borrowing from the bank to get the loan to create leverage and high rates of return. The second way is using the tenant's money, that income stream, to pay and control the mortgage and hopefully have a little bit left over after I pay the mortgage and all the operating expenses, called cash flow. And the third way I get other people's money to ethically work for me is with the government's money for very generous tax incentives. So, really, that's a new framework for a lot of people for thinking about the best and highest use of your investing dollar in the best risk adjusted asset class I have ever heard of real estate. You're getting other people's money to work for you three ways at the same time: the banks, the tenants, and the governments. So that's how you're really getting ahead. And that's how real estate investors that are strategic really get ahead in life and really build legacy wealth. It's other people's money, not just your own.
It's a completely different way of thinking.
Yeah, yeah, it really is. It's a new way of thinking. It's really a new investment paradigm.
Now, many times when we get out of school or training or whatever, we'll go meet with a financial advisor, and they'll sit down and say, okay, well, we're going to set you up with a 30 or 40-year plan. And they have all these graphs and everything. And they say, look, you start putting in a little bit a month in your 401k or whatever, and then look in 30 or 40 years, look at what compound interest is going to do. This compound interest, if you would just sit back and wait till you're 70 or 75, this compound interest is going to help you build wealth. But you have a different take on that, right?
Yeah, you bring up a really interesting point. A lot of financial advisors talk about compound interest. And when you look at compound interest on a chart, it looks parabolic. It increases, it's something like this. It exponentially with that compounding. I think a great question for you to ask your financial advisor that's really going to put them back on their toes. It's an even better question than, are you beating the S&P 500, Mr. or Mrs. Advisor? There's an even better question than that, although that is a good question. And okay, you can say, I see what compound interest looks like on a chart, just say with 10% compounded in the S&P 500 over time. I can see what the S&P 500 does. But hey, Mr. or Mrs. Advisor, what's my rate of return after the effects of inflation and emotion, which causes people to buy and sell at exactly the wrong time, like I described earlier, and taxes and fees and volatility? What's my return after those five drags? Because that's really what you're after. I think a lot of people don't ask that, and they think their return will chart exactly what the S&P 500 does. Now, if you're in an index fund, you probably do remove that component of emotions getting in the way, but you still have all those other drags. You want to know what your real rate of return is after inflation, taxes, fees, and volatility with the way that some of the returns are calculated. So ask your advisor a better question as you postpone a lot of your life and store away these dollars for later. Oftentimes, it really aren't even meant to generate any income for you in all those decades of your life from now until then. So that's a better question to ask your advisor.
So it's for somebody out there that's looking to eventually get out of the rat race, they're trading time for dollars. All they have is just active income. That's all they're focusing on. And they want to start adding some passive income. They maybe go over maybe what are some of the different types of properties that would be maybe like the best buy and hold types of properties. That way they're getting the cash flow coming in. They're starting to replace some of that active income.
Yeah, I think that's a good question. Like how to start. In
Mhm.
short, I would say you can start small, but think big while you start small.
Okay.
So we look at property types. First of all, I think the property is only the fourth most important thing in real estate investing. Maybe we can talk about that later, but it's still the fourth most important thing. So really, there are a lot of things that you want to avoid with an ideal rental property. I like to buy from turnkey real estate investing companies. What turnkey means, and there are companies in various markets in the United States, Midwest, and South that are in business to do exactly this, provide you with a turnkey property. So, what's turnkey really mean? It's kind of a funny sounding word to some people. It really means three things. It's a property that's either fully renovated or brand new, already has a tenant in it, and is already under management on day one. The turnkey company often manages that property themselves. But some of the things to avoid are you generally want to avoid really high priced properties like luxury properties. It
Mhm.
seems a little counterintuitive, Jeff, but actually, like the word beautiful, which is like a common realtor marketing word, it's something you want to avoid when it comes to just bread and butter, durable rental property. So I like to buy something that's sort of just below the median for an area. And the reason why is because that's typically the class of real estate where I get a high ratio of rent income in proportion to a low purchase price. That's where I get a good rent to value ratio, a high rent to value ratio. That's something I want to look for. And another reason why oftentimes I gravitate toward the Midwest and South, and in general people should, is those tend to have states that are landlord friendly, where you can get an eviction in a relatively short period of time for a non-paying tenant. And those also tended to be those states where they didn't let those eviction moratoria run on and on and on in the pandemic. So these are three reasons why I like the Midwest and South. And that's about the
Mhm.
class of property that I look for.
Okay. And you just mentioned a little bit, but as you were starting that topic off about the property is only the fourth most important thing in real estate. What do you mean by that? What are the other three?
Yeah, I think that's a really natural question because, usually when you as an investor, when you think about a real estate investment, that property comes to mind first. I think that's
Mhm.
a very natural jump to make. But let's just drop back and not get too, emotional about a property. This is an investment. We definitely want to keep emotions out of it. The most important thing in real estate investing is you. What do you want real estate to do for you? Because it's a certain property type that's going to cater to that. And what I mean is, are you looking for the production of passive income, which is the most common thing? Are you looking for appreciation? Are you looking primarily for tax benefits? Or even looking for a lifestyle investment that you could use and enjoy a few weeks yourself? A turnkey property in Memphis, Tennessee, it's typically not, where you want to vacation for 1 month a year. So what do you want real estate to do for you? You are number one in this hierarchy of what's important in real estate investing. The second most important thing is the market. We can think about that in a few ways. We can think, residential or warehousing or retail. The way trends are going, residential real estate is really the place to be. And a lot of the markets that we want to be in are some of the mid-sized to bigger metros in the Midwest and South. Because you could buy a good property today, but if it's in a market with declining population and declining job counts, you're not going to have a tenant that's going to be able to pay the income in that property. So that's why the
Right.
market is actually the second most important thing. And then the third most important thing is that team of professionals that you surround yourself with, especially that key property manager. I have property managers for all of my properties in various markets. Because again, the reason I'm doing this, a lot of people do it just for the income, but I'm doing it for the outcome as well. I want to have a good outcome. I don't want 80 tenants all to be able to text me, letting me know that their kitchen cabinet doors are a little bit loose, or a carbon monoxide detector needs to be installed or something like that. So I have a manager, a trusted manager in every market, that team being the third most important thing. And then once you're aligned on those first three things, you, the market, and the team, think about how now you're so ready to buy property. You've really done your homework. And Jeff, I see so many. In fact, I would say the majority of real estate investors, you know what they do? They make a mistake and they kind of do it backwards. They might get a little emotional about a property that looks beautiful,
Mhm.
and then they buy the property, and then they try to find a manager in that market where they bought the property. And then they try to figure out the market to see if the market's going to be good for the long term. And they do it completely backwards. They flip it over. So the property is only the fourth most important thing. I'm not saying it doesn't matter, but you, the market, and the team are actually more important than the property. And now you're starting to invest with a top-down strategy where you really elevate your chances for success over time. Yeah, the property is only the fourth most important thing among all this other heresy I'm talking about today that sounds counterintuitive. That is a truth that I found in my almost 2 decades of doing this now.
So, Keith, in your opinion, do you think that long-term housing and demographic trends they really benefit the real estate investors today?
Yeah, and I just touched on it a little earlier, so I'm glad that you asked more about it,
Mhm.
Jeff. Yeah, why residential? Are those trends really conducive to investing in long term? Like, is that a durable source of income? And it is durable, and I think it's become even more so with what's happened a little over 2 years ago. I mean, you can look at the decline in office. I mean, imagine if you had office buildings through
Yeah.
the pandemic that you were renting to other people, or retail has seen such a substantial decline. And a lot of those trends aren't going to come back. And there are some classes of real estate that have been quite favorable. Actually, warehousing, like this last mile warehousing, warehouse space, has actually become really desirable. And so has residential real estate, which is primarily what I talk about. The nice thing about residential is I think people inherently understand it because you, the viewer here, one thing I know about you is you have always lived somewhere. Okay. You might not understand warehouse or self-storage space or some of these others, but in fact, real estate on the residential end has seen an increase in utility starting with the pandemic, really. And utility just means usefulness. It's kind of a word that throws people off. Utility doesn't mean paying your electric bill every month, but a home is actually more useful to people now, as we know about the work from home trend that started a couple years ago, people working on Zoom. But increasingly, a home is not only where you more likely work now, it's where you might exercise from home and you might homeschool now. And there's kind of been this increase in self-reliance where people are more likely to have something like a home garden or a home greenhouse. So the home has really become this center of the world, and it's become more important to people. And besides utility, another really important trend in residential housing is supply, this astounding dearth of supply where we're undersupplied. In fact, depending on the measure that you look at, we need 3 to 5 times more residential housing than we're able to supply. With what's going on with supply chain shortages, that's a pretty inelastic condition. It's not going to change anytime soon. So when you have something with great utility, increasing usefulness to more people, and a low demand for it, that's why you're seeing prices rise so much. I don't think we're going to see prices rise this year as much as we did last year, but it will continue to rise. Those are two big reasons: utility and supply. And when it comes specifically to pricing, what really happens is when you have a low supply of something and you have so many more people that want this thing, including this huge cohort of millennials who are the biggest age demographic in the United States, and that age demographic is of prime home buyer age. When you have all these people converging on few homes, what does that continue to do? It continues to fuel bidding wars when you have this low supply and a growing demographic that has high demand for it. That's why prices are going to continue to stay elevated for a while, even in the face of higher mortgage interest rates.
Excellent. Keith, really appreciate you spending time with us today. I know you're on your website. You've got some really good resources. What are some of the ones that we could point, maybe like the newbie investor on the GetRichEducation.com website? What are some of the resources maybe that you can steer them to start with?
Yeah, to start with, I'd say an easy thing, the Get Rich Education podcast. If you don't know about podcasts, you can just grab the Get Rich Education phone app and listen that way.
Okay.
And then on the website, one thing I've really keyed in for helping you out there at GetRichEducation.com is my free video course. It is 5 videos. They're each about 12 minutes long. And in that, only about 1 hour, you understand the 5 ways you're paid. So each of the 5 videos covers one of the 5 ways you're paid, like I described earlier. And the importance of understanding the 5 ways you're paid is now you know what to optimize. Now you know what property to seek. Now you know what property to avoid. When you understand all 5 ways that you're paid, you can really holistically understand real estate. It's really something that billionaire real estate investors often don't understand, the 5 ways that you're paid. And I made that free for you at GetRichEducation.com/course. So it's a free course on the 5 ways real estate pays. I'm the one in each of the 5 short videos, break it down each way. It's kind of funny, Jeff. I wear a different color shirt in each one of the 5 videos for the 5 ways that you're paid, and each color symbolizes one of those profit centers: appreciation, cash flow, loan pay down, tax benefits, or the inflation profiting benefit. And that course is free at GetRichEducation.com/course.
Awesome. And I'll make sure everybody that we'll put a link below this video for that, so you can grab his resources. His podcast is great. I've been listening to it for years. I continue to do it. Well, I told him I've shifted over more to the YouTube, which side of it, but you still get the same education. It's just easier for me to consume that. So again, I really appreciate you spending time with us, educating us, especially on the 5 ways that you can get paid with real estate.
Yeah, that's revolutionary to most people. So, hey, I enjoyed talking about it. This stuff fires me up, Jeff. Thanks so much for having me.